Thank you everyone for dialing in. I know it's a slightly awkward hour, 4 p.m., but it's not easy getting transatlantic webinars all sorted. So welcome to the Pinnacle Listed Learnings webinar series. We're here today to talk about listed closed-end funds. It's 7 o'clock in the UK, which is where our guest speaker, Ian Sayers, who's either above you or to my left, depending on how your screen looks. So welcome, Ian. And welcome to the listeners. My name is Chris Mayer. I run the listed funds business at Pinnacle Investment Management. We're a very active participant, as most of you probably know, in the listed closed-end fund industry. And I have to say, it's been a pretty depressing place to be in the last few months. You know, we've had persistent discounts on the industry's LICs here relative to their net tangible assets. We've even had some listed closed-end funds convert to open-ended trusts. So it's sort of given up completely, if you like, on the closed-end listed structure. And more recently, we had some news from the regulator around the ability for us, or the lack of ability, to pay selling fees to distributors of listed investment companies. So in my sort of depressed state, I thought, let's look abroad, try and find a market where they have survived and thrived despite many of the same challenges that we face in Australia today. And so I came across the UK market where they have, came across the UK market where they have had many similar issues to us about a decade ago. And Ian Sayers is the CEO of the UK Investment Company Association. And so we're very lucky to have him today. We're going to spend a bit of time talking about some of the issues that they faced a decade ago and how they survived and thrived right through it. It's probably the most successful investment company market in the world. And so I'm sure there's quite a lot that we can learn from the UK. So Ian, with that, why don't you give yourself a quick intro, if you might, and an intro to the AIC.
Yeah, well, thank you very much, Chris, and thanks for the opportunity to speak today. I think there are some parallels here. I joined the industry 20 years-ish ago, not as the CEO of the AIC at the time, but at the time in the press, I think the word that was most commonly used about our sector was beleaguered. They're very much a view that the industry was in terminal decline, and it hasn't worked out that way. So hopefully I'll be able to give you some thoughts as to why that wasn't. Just very briefly, the Association of Investment Companies, it represents listed closed-ended funds. That's the only people we represent. We don't represent the managers, the brokers, etc. We work very closely with them, but we're very clear about whose interests we represent. And yeah, we do the things that most trade bodies do. We lobby government, we give technical advice, we do media work, we have a website and produce the statistics for the industry. But my background is mostly was technical and regulatory, which reflects the fact that post the sort of banking crisis, one of the big challenges we've been facing is an absolute onslaught of regulation, particularly from the European Union.
Great, thanks Ian, and thanks for getting up early to do this. So I think we're going to have about a 20-minute presentation from Ian, and then we'll do about 10 minutes of Q&A for those of you who haven't used Zoom a lot, which given COVID, I'm sure none of us are apprentices on Zoom anymore. But if you do have a question, please feel free to type it into the Q&A box at the bottom and we'll get to you at the end. So without further ado, let me just get into the slide presentation, which is over here. Okay, so just a quick setting the scenes. Most of you probably don't look at the UK listed investment company market, so I think it's worth just characterizing what it looks like relative to the Australian listed investment company market. So the first three rows of this table would show you that the UK is much older and much bigger than the Australian market. Not a huge surprise. Obviously, the UK just is a bigger market in general. What's probably more interesting is the bottom two rows, where you can see that today about 90% of the assets that sit inside listed investment companies in Australia are made up of listed equities, whereas in the UK that number's all the way down at 45%. And I think you'll hear from Ian a bit later as to how the growth in sort of non-listed equity assets drove a lot of their industry growth over the last decade. And the second is the discounts to NTA. So as I mentioned at the start, at the moment, the discounts in Australia are very wide, bar some of the oldest LICs. Most of the LICs in Australia are probably at double-digit discounts, some of them as wide as 20 to 30%. In the UK, they had that problem maybe a decade ago, and discounts today are much narrower. So I look forward to hearing from Ian as to how the industry overcame the discount to NTA issue. So Ian, I'm going to hand over to you to run through your presentation.
Okay, thanks very much, Chris. I'll just start with where I think we are literally today, and then we'll go back in time a bit. Not surprisingly, like a lot of people in the world, we had a bit of a shock in the middle of March because of COVID-19. We saw discounts widen out to really quite wide levels, historically speaking, although I'm going to pick up again on Chris. I'm going to go back a little bit further in time than even 10 years ago, because our discount issue was even more dramatic, say 20 years ago. So I'll try and take in that perspective. I think what's been really surprising is not that those discounts did widen out, but how much they've come in, and I'll explain the reasons for that. But I think we've got to be, there's quite a positive message from the UK's perspective here, but I think we've also got to recognise, I inevitably talk about averages and that sector as a whole, but there are certainly some sectors in the UK that are struggling more than others, particularly on the property side of life. If I could have the next slide, Chris. So just to say where we are, I think this shows the sort of relative resilience of the industry. We reached 200 billion of assets at the end of last year. If you look at the end of May, as you can see, not that much of a fallback at all in assets, a 2 or 3% drop. It did drop a lot more than that in the middle of March. And I think the natural feeling, particularly of retail investors in the UK, is that's quite a strong position, because the UK market itself has had a tough time. It's still down about 15–16% from where it was at the beginning of the year. If we can move on to the next slide. And there's quite an interesting thing in terms of performance relative to the UK market. This shows, by the way, the green line here is effectively the investment trust index. It's called something slightly different by the London Stock Exchange, but that green line is the investment trust index, and the grey line is the FTSE All Share. And as you can see, for the first half of the year, pretty much tracking in line, perhaps surprisingly tracking in line with each other. But as you see, as we get into the recovery on the main market, the investment trust sector significantly outperforms. Probably that's more to do with, I would have to say, the FTSE All Share underperforming than us outperforming. But nonetheless, I think it does reflect a variety of factors. The fact that we're not so exposed to the UK, the income story, all of which I'm going to come to, but a big outperformance relative to our main market. Next slide, please. We're going to talk a bit about the discounts. I'm going to just talk a bit about the long-term sort of historical perspective and the more immediate one this year, because they're a very different story. And again, if I had taken this slide back a further 10 years, this line that's sort of going upwards on this slide would have carried on trailing downwards. 20 years ago, average discounts in the sector were more like 20 to 25%, which was one of the reasons people felt that the industry was really going to eventually disappear. But as you can see, the trend over the last 10 years, and actually the trend over the last 20 years, has been a long narrowing. And in fact, we have never seen discounts as narrow on average as we have seen them in the last 5 or 6 years. They've been hovering around about 5% or so. And there's a variety of reasons for that. There is more demand for the sector because of some of the asset classes we're offering, the income story, which I'm going to come to. But if we go to the next slide, one of the biggest changes that we have seen is what we call discount management techniques. They're sometimes called discount control mechanisms. These are relatively new to the industry. In fact, virtually the first job I ever did for the AIC was to lobby for it 20 years ago to allow us to be able to have the power to buy back our own shares. Before 20 years ago, we were prohibited, so we couldn't go into the market. And so the idea behind doing that is that if you accept that discounts are something to do with an imbalance between supply and demand, you've either got, you've too few shareholders wanting to buy, you can obviously try and increase demand, which is obviously a good way to do it, but it's often the more challenging. The alternative is actually to buy out some of those shareholders who don't really want to stay and who are net sellers. And we had a lot of institutions 20 years ago that were net sellers of the sector. Now, over those 20 years, people have tried lots and lots of different techniques. They got increasingly more sophisticated at times with lots of complicated kinds of tender offers, etc. I'm not going to go through those because actually the two that have reasonably worked well is just the classic share buyback. So the company uses its own money, goes onto the stock market and buys back its shares. If you do that at a discount, you enhance NAV for remaining shareholders, which is a good thing. But actually you can also, it does narrow discounts. I mean, I think there's no doubt at all that if you're prepared to stand in the market and buy the shares, your discount will narrow. However, it is easier for some companies than others. So some of our biggest and largest member companies with listed liquid assets have been able to set almost formal targets. So they've said we'll target 10 or 5% or whatever. It's much harder if you're smaller with illiquid assets because clearly you have to raise the cash to do the buyback. And the other one has been to have continuation votes, a regular opportunity to say to shareholders, look, if you do want out, you can get out at NAV. Again, those have a mixed reception again, but they have given people confidence that they can invest in a fund, knowing that there might be an opportunity if things don't go well. If we move on to the next slide, please.
Maybe before we move on, just to bring it back to the Australian experience, most LICs now, I would say in Australia, particularly where they're trading at a big discount, are trying to close the discount through share buybacks, but not many of them are working if the evidence is defined by whether the discount is actually narrowed or not. Can you maybe give us a feel for whether it just took time maybe for the buybacks in the UK to actually take effect, to sort of mop up that selling interest imbalance that you refer to? Or was there something in the way the buybacks were done that maybe was what made them effective in the UK?
I think that there's a couple of things, and this is a very similar discussion I remember 20 years ago when we got the power. There were some companies that said, we are not going to buy back shares, it won't work. Others said that they were going to buy back shares, but didn't really communicate that they just went into the market and did it piecemeal. They didn't really have a strategy. A lot of directors at the time, the last thing that you would do is tell the market what kind of target you're aiming for. And then and this went on for a few years, and then some companies said, actually, no, maybe we are going to. So Foreign and Colonial, which is one of our biggest investment trusts, said, no, we're going to say we will buy back shares until we get to 10%. And they committed to it, and it cost them quite a lot of money. Then they got into closer towards par, and then they said, okay, we're going to put a floor underneath it at 5. And again, they had to sort of do that. So you've got to commit, and you've got to be willing to do it. And that can be quite a scary situation if you suddenly have a lot of buying demand. But yeah, I think it's a commitment, and I think you do need to communicate it, because part of the success of Foreign and Colonial was the fact that I, as an investor, if the discount went out wide, it was a real buying opportunity because we were confident that the discount wouldn't go any further. Okay, and this year, I think, is a very different situation. There's that long-term picture of buybacks and that kind of thing. This year, as you can see, this is the average discount of the sector this year. Very, very low at the beginning of the year, suddenly widens out dramatically. That's not a great surprise. It got to about 22, 23%, but it came back in very, very quickly. And I'd love to say that we did something amazing to intervene in the market and put this back, but we didn't. That nothing happened at all. This was the market. People saw the attractions of income, yield, dividend yields rising because the share prices were falling. And I spoke to some brokers a couple of days ago. They've said they've never seen a period where every class of shareholder started buying towards the end of March because they saw it as a real buying opportunity. So the market sort of effectively sort of took care of this discount of itself, but it was a very dramatic period, very scary at the beginning of March, and then everything calmed down a little bit towards the end of March. The next slide. And normally in a market of this nature, fundraising would collapse, and it's been a bit of a mixture actually here. In IPO terms, new fund launches, it has collapsed. With the only launch we've had this year was before COVID hit, and it was a very small launch. As you can see, there's been virtually no IPOs, and I don't expect that to change for some months. I'm afraid launching something where you can't meet people, it's just not the way our industry geared up. It may change, but it's not the way we're geared up at the moment in the UK. But secondary raising by existing funds have continued, and actually this year I think will still be better than, say, 2011 and 2012. And I think the one word we have to say for that is income, the income story in the sector, and I'm going to come to that. But it's okay, actually fundraising has held up reasonably well. Next slide, please. So yeah, let's talk a bit about the reasons for this. The first is the income story. In the UK, we differ from open-ended funds. We have a number of advantages over open-ended funds. The reason is it was almost historical accident. There's no real regulatory logic for it, but we have the ability in particular, we can hold income in reserves in good times so we can pay it out in bad times. Open-ended funds have to distribute everything. Every company in the UK is cutting their dividends. We're looking like the UK stock market will be about 40% down this year. Open-ended funds will have to cut their dividends. We, however, have built up enough reserves. We should be able to maintain it for this year, possibly next year if things don't recover. Beyond that will become more tricky. The next area is actually what we're exposed to, and this has been the biggest change, I would say, in my 20 years, because it isn't just a market today of investment companies invested in listed shares. So if you go to the next slide, this really demonstrates it quite dramatically. A 20-year perspective, but the important point is that red chunk there is traditional equity mandates. Everything else is either non-equity or equity mandates which aren't a traditional thing. So we have some sort of other equity mandates, but they're not necessarily always long-only strategies. And as you can see, well over 75% of that was traditional equity mandates in '99. Today, it's now down to closer to 45%. And the things that are making up that increase share two factors. Firstly, they are illiquid asset classes, which we'll come to in a bit more detail later, but they also tend to be income producing assets as well. So infrastructure it's an income producing asset, debt is, and so on, and direct property. So those two stories have been very, very dominant in changing the shape of the industry. The equity market's still there, but it's relatively static, whereas the others are very fast growing.
Ian, this is fascinating. I mean, I would say Australia looks very much like the pie chart on the left today, 80-90% listed equities. The question here, and actually it comes from Rob, so I'm sort of preempting the Q&A a little bit, but I think it fits into the slide, is do you tend to find that the illiquid asset classes like direct property, credit, infrastructure, when you look at the NTA discounts or premiums that those IC investment companies trade at, are they generally better than investment companies that have listed equities in the portfolio?
I would say yes, but not as dramatic as you might think. But certainly we've had certain situations actually where some of the directors have more problem with premiums rather than discounts. So infrastructure has always traded at very significant premiums, 10 or 15% premiums. Property did for a while. You're right, but I would also say that in the equity side, it's a difference between, again, those income producing equity sides are also trading at premiums. If you go to private equity, then it is trading at quite a significant discount. So private equity at the moment is around 20-25%. So there's a split in the equity market. As I said, the number one driver of premiums and discounts, I think, in the UK at the moment is the yield you can pay. So just carrying on the reasons, I think, as I said before, the FTSE all share has performed very badly, as well as regards worldwide markets. We're not as exposed to the UK markets as we used to be. Again, we used to be sort of 2/3 invested in the UK. That's changed. Private equity, I just mentioned, very, very tough time after the banking crisis. There was some real, I suppose the best thing you can say was buying opportunities there, but a very tough time for private equity. They are holding up much better in this market, albeit that their discounts have widened. But the final issue I wanted to mention on the reasons for is about illiquid asset classes, because I think this is an area where the view of closed-ended versus open-ended is changing quite sharply in the UK, and I think potentially is a source of competitive advantage for this particular structure. So if we could move on. So I'm going to give you this background. This may not be completely familiar to you, but it is probably the #1 financial services news story in the UK. It started a long time ago, after the banking crisis. We do allow open-ended funds in the UK to own property, and they suspended after the banking crisis because too many investors wanted out, but you couldn't sell the property in time. We saw exactly the same thing after the Brexit referendum, a very sharp downturn in demand for property investment. And again, a lot of fund, in fact, virtually every open-ended property fund suspended, some for up to 6 months. But the thing that's really driving this debate in the UK is what happened to Woodford Equity Income. Now, Neil Woodford ran a fund, a very famous fund manager in the UK, fantastic track record, launched his own UK Equity Income Fund, went to 10 billion of assets very quickly. And he invested, rather than invest directly in just UK equity income, the traditional sort of, FTSE 100, etc. stocks, he did put a proportion into less liquid stocks or even unquoted. Performance wasn't great. There was a rush for the door and they had to shut the fund. And in fact, we're almost exactly a year from when they shut the fund. It hasn't been able to reopen. It's had to liquidate. Shareholders, a lot of retail shareholders were in it, hundreds of thousands. It was massive marketed. And just to add insult to injury, the latest story is that the liquidator of the fund sold some assets. They managed to get rid of them after a year to a party who's just announced that they flipped them to another party for 12 times what the fund sold them for. So that's gone down very badly. So regulators are really interested in this. Had further suspensions at the end of 2019, and then no surprise, COVID-19, all the property funds have had to suspend again because they just can't value the underlying assets. And by suspension, just to say, means no one can go in, no one can leave, and basically the manager is just fire selling assets to get enough cash so that they can reopen. So if you go on to the next slide, and I think this is a concern for us. It's not just about the competitive side of life. I mean, we have closed-ended property funds. We had a Woodford fund that is in a closed-ended structure. And of course, share prices haven't been great, but we haven't had to suspend the shares. People can trade in and out. But we are worried about open-ended funds getting into this position, because if they start selling the same assets as we own, there's only one way the prices of those assets are going. So we produce this rather striking document called Square Peg in a Round Hole to say, actually, you can't have an open-ended fund that has assets that may take a year to sell, but offer daily redemption, which is what all our open-ended property funds do. So we've said we want this concept of reliable redemption. I won't go into it in detail to save time, but basically I think the key element here is we're saying you have to get investors to give a notice period. You can't say to them, you can have your money out instantaneously. There's lots of funds in Europe that are closing for similar C19 reasons. So we're saying you might have to say, in Germany, for example, they do it differently. In Germany, if you own a property fund, then you have to give a year's notice if you want your money out. And that gives the manager time to sell those assets. So that's what we're suggesting. There are other conditions there. If you're interested in reading the report, it is available on our site, but that is what we're looking for. And the Bank of England over here and the Treasury, I think, are going to take some form of action, although it probably won't be as exactly what we're suggesting. Next slide, please. But I wouldn't want to leave you with the idea that everything in the garden over here is rosy. It absolutely isn't. At the moment, there are some sort of relatively mundane technical challenges that we're dealing with. The biggest issue at the moment is just holding AGMs. We are a bit in AGM season at the moment in the UK. That's a big problem because most of us don't have the power to not hold a non-physical AGM, if that makes sense. It means, so we've had to have legislation drafted to give permission not to hold physical AGMs. Valuations are a big issue. Property sector, private equity sector, very difficult market to give reliable valuations. Some members have even stopped giving valuations. And I think the market's been reasonably sympathetic to that because it is very, very difficult. Yes, we have some dividend advantages, but that doesn't mean every sector has been immune to that. We have seen a lot of members cut dividends, particularly in the property side. I've mentioned IPOs. But I think probably the number one sector that's really struggling is the property sector. But overall, the analysts, I think, are reasonably comfortable with that. It is very, very hard to run a property fund if your tenants are all shut and not paying their rent. So you can't get away from that reality. But nonetheless, you can at least get out if you want to, which you can't if you're in an open-ended property fund. So I was also asked just to talk about the fact that you've had this issue with sales incentives. It's a slightly different position in the UK. It is too complicated to get into in this environment, but we were looking at sales incentives generally in the UK back in 2013. We had a major reform called the Retail Distribution Review, and it did two things. Firstly, it abolished commission for financial advice. Now, investment trusts could partly pay commission and partly couldn't. We were restricted on paying commission in the secondary market. We could pay it on IPOs and other savings products. So it was a bit of a mixed bag, but we didn't have full freedom to pay commission. Open-ended funds could pay commission without any restriction, and that's one of the reasons that they grew so much quicker than they did in the sort of 80s and 90s. But it also banned any payments and incentives to platforms. So I'm talking about share dealing sites and the like. Share dealing sites used to get commission off open-ended funds, but not us. And so again, there was a big incentive for them to promote it. So all of this was banned, and it's been quite good for us. Actually, I know it's a slightly different position for you, but it's been relatively positive for us, although I wouldn't overstate it. Yes, financial advisors are recommending more investment companies in the UK than they were before. There's been about a 5-fold increase, but from such a low level, and open-ended funds still dominate this market. Platforms, 3 or 4 major platforms didn't bother to offer investment companies. They now do, so that has been helpful. But I wouldn't say it was, massive at this time. It's improved the situation. What I would say is don't underestimate, the transition can be challenging. I'm sympathetic to the feeling, the industry over there is going to struggle because of this change. There will be challenging times. It was for us. There were people lobbying to abolish this right up to the last second. But actually, I think overall, it's a good thing. I do happen to believe if you think you've got a good product, then it would be better if you could have a level playing field to compete on your merits, performance or whatever, than just by who can buy the most distribution. And all the way through our market, we've seen problems. Neil Woodford's fund, there was an incentive, and that's why Hargreaves Lansdown, which is the biggest retail broker in the UK, put 1/3 of their clients into one single fund, and they've all suffered huge losses. And that was driven partly from the deal that they were prepared to cut for that one single platform. So if we move on, I think on the concluding slide. So just to say, I think things going reasonably well in the UK. Income and illiquid assets are the key drivers there. And I think maybe thinking your industry, because you are very much where we were, a little while back. But I actually think that the closed and open-ended distinction, I said a year ago, if you'd asked me that if I'd ever be talking in the media about closed versus open-ended, I would have laughed at you. It just doesn't happen. It's just too technical. It's too nerdy, I'm afraid. But I found myself on BBC News, live on BBC News, explaining the difference. And I think this is going to happen. I think it is happening at a global level, where people are beginning to say, actually, the difference between open and closed-ended is not a technical nuance. It is important. And we're seeing some of the problems emerging in the UK by putting the sort of the right assets, but in the wrong structure. And I think that's something you might just want to think about from your company perspective, about it, institutions around the world want more of these illiquid assets. I would personally say you don't want the open-ended sector to take hold of that. If you could have the closed-ended sector, I believe it will be much better in the long term. But I just say, this is a huge, human crisis that we're going through at the moment. The economic crisis has yet to hit the UK, so I'm not claiming victory. I'm certainly not gloating. It would be totally inappropriate. We've still got some very difficult times to go. So we haven't been, I think, in the UK yet fully tested. Okay.
Great, thanks, Ian. That's very helpful. It's fascinating, actually, how your industry has morphed despite some challenges. Hopefully, we can do the same here. Thanks to the listeners for all your questions. They're coming through thick and fast. I'm sure we won't get through them all, but we'll get to you in written format if we don't get to them now. So the first question actually is similar from both John and Amy, and I think it relates. I'll try and summarize them together, which is, can you give us a feel for who the typical investor is in a UK investment company? In Australia, it's predominantly retail, a mix between direct and sort of advised retail investors. Can you just give us a feel for maybe who the bulk of the shareholder registers would be in the UK?
Yeah, and I think we've got to break this down a little bit over time and also different asset classes. So 20 years ago, we had a mixture of institutions and retail in equity mandates. Those institutions sold, leaving us with mostly retail. So very similar to, I think, the perspective you're viewing, not completely, but mostly retail investors. As the alternatives have come into the equation, we have seen an increase in the institutional holdings. So it's very difficult to give precise figures, but I would say we're still about 60-ish% retail, 40% institutions, but the alternatives are much higher institutionally held. The equity side, most people are looking for the retail market to do that. Most of the retail is either direct retail, i.e. literally coming through platforms which are growing very sharply in the UK. And the advice side, it's mostly the wealth management side, more discretionary mandates, that kind of thing. The financial advisor is very small still, it's 1 or 2%. That's the area that we're trying to grow, but it's quite a challenge to do that. So yeah, it's a mixed bag, but it is mixed in relation to which different asset classes you're talking about.
Yeah, and maybe sort of on a similar vein, both from, was a question maybe from Alex, who's probably a broker, is, can you explain to us how this relates to the sort of stamping fee, Royal Commission, RDR kind of topic, which is, how are investment companies distributed when they're looking to raise new capital in the UK? Who gets involved, and has that changed very much as the sort of sales incentives have the sort of regulation has leveled the playing field?
Yeah, I mean, I think if you're talking about, and again, if you're talking about a new fund launch, then the driver of it in the UK is the investment manager. Essentially speaking, they're going to put up the costs. They have the idea, they create the structure, and they're going to pay the cost if it doesn't get off the ground. So they put their neck on the line. Now they will use a sponsoring broker who will help to drum up demand for that, and they will get paid, although it's not really quite commission in that sense, but they'll get paid a fee. But it's the manager that's driving it. They don't get incentivized to do that, other than the fact that, of course, they're going to pick up the management contract. And so that's the driving focus there. And as I said, the number of IPOs, I would say they're generally in decline, because it's getting a bit harder to get these funds off the ground, because a lot of the investors that you would normally go for backing from, the big wealth managers, are increasingly wanting larger and larger funds. So it's getting more of a challenge there. For an existing fund raising new money, it can be, generally, again, it will be going through more institutional sources. We don't tend to do direct fundraisings from retail investors. We can do, but we have to do a prospectus and things like that. And again, you've got the demand in, your broker or whoever will go and talk to the institutions and maybe place shares directly out on them. But sometimes we just have the capacity just to issue shares out onto the market. So you literally take the power from shareholders. We call them a tap issue. I don't know whether that's a term familiar in Australia. And we'll just literally issue the shares out into the market generally. So there's a variety of different ways. But I would say in our space, the manager has a really strong incentive to drive the process, because ultimately they end up with greater funds under management.
Yeah, and then just on maybe to put a shareholder hat on, two questions, one from Simon, one from Lorraine. So Simon's asking, what mechanism, if you like, does a shareholder tend to have to force a company to make a dramatic change, like, I don't know, wind itself up or convert into an unlisted trust? In the UK, how would a shareholder tend to try and approach that challenge? And then secondly, you mentioned continuation votes. It's not something that's particularly common in Australia. What Can you just give us a bit more color on what it is, and how does the manager who, you know, thinks that it's got this sort of long-term contract to manage the assets of the company, how do they, what do they win or lose in a continuation vote?
Yeah. Okay. On how, what do shareholders' powers do they have? I mean, all shareholders have ultimately the same powers, but some are more powerful than others. So if there is going to be radical change, firstly, I'd say, you know, we do make it, I mean, these have independent boards of directors. If things are going badly wrong, hopefully they would be doing their job and thinking about making changes anyway. They will meet with shareholders, and if shareholders are unhappy, they will let the directors know, and they might take preemptive action. If the shareholders don't, then the shareholders have powers to vote. You can convene an EGM, and you do occasionally see it. Obviously, if you're a direct retail investor, your power is usually quite limited, but institutions, larger managers will take action, and they will effectively, you know, force the issue. Usually it doesn't come down to a vote. I mean, so it doesn't come down, you don't force them, the directors, by vote, because by the time you're getting to threatening an EGM, directors know that they're going to have to do something. But sometimes they resist directors. Occasionally they may not think it's in the best interest of shareholders, and you might get some really hostile shareholders. We call them arbitrageurs, some people call them vultures, who just buy in the intent of winding up the company. And we have a few of those, you know, come along every so often, and it can get really nasty, and it goes very public. And they will just antagonize the company until it gives in to their demands, or eventually they will go away. So there's a variety of different mechanisms, but ultimately shareholders are in control. Continuation votes are a bit of a mixed bag. I think the advantage of a continuation vote is more when you launch rather than when it comes up to the continuation vote to some degree. If you say to people, we want you to back this company, they might say, well, this asset class sometimes goes to 25–30% discount, we're not going to back it. If you tell them up front that they will, in say 5 years' time, get a continuation vote, they might be prepared to put their money up. When you get to the continuation vote, obviously the manager is heavily incentivized to get it passed, so you carry on, you continue. I have to say, in terms of bringing in discounts, it's a slightly odd situation. If the fund has done quite well, but nonetheless is trading at a bit of a discount, the continuation vote just gets passed, and it doesn't have any impact on the discount. Ironically, if things have been terrible, it will absolutely bring the discount into zero, because everybody knows that the continuation vote is going to be failed. So there's going to be a liquidation at asset value. So but I think it's the confidence it gives to get people in the first place that's been its biggest benefit.
Yeah, and maybe just the final one, in the interest of time, we've got plenty of questions, as I said, but we won't get to them, is just obviously one of the concerns for an industry, if you don't get a lot of IPOs and most of the capital growth comes through share issues, through, you know, taps, as you say, or secondary offerings, you potentially stifle innovation because you don't let sort of younger asset managers or boutique asset managers to bring strategies to market. It's really the big dominant asset managers that already have LICs or just have big brands that, you know, can do it. So what have you seen in the UK in terms of the mix of type of manager that is able to actually successfully list a closed-end fund and have sufficient scale for it to be successful?
Yeah, this is a big question actually for regulators in the UK who are looking at the broader picture of the demand for asset management services. There are a variety of factors. I think you're right. This is you know, it's more difficult for smaller entities to get involved. Part of that is regulation. We have had a huge, I mean, absolute deluge of regulation, and big, large asset American-backed firms. This is absolutely music to their ears. They complain about regulation, but they actually love it because they've got massive back offices, and we're having to produce so much information for regulators. It's just gone up exponentially. The tide is beginning to change. I mean, actually, we used to have about 200-ish people managing in our sector, probably a bit less than that, say 10 years ago. There's a lot more now, but I wouldn't say there are as many. They're not really boutiques. We see them as, you know, new entrants, but they're people who ran open-ended structures and are now getting into the closed-ended space. They're not necessarily small managers, but there are some smaller vehicles out there, but would I call them boutique? No, I probably wouldn't call them boutique, but they feel boutique for us because they're all names we've never seen before. But then you suddenly discover but they're managing X billion in listed, private partnerships and other kinds of structure. So that is definitely a big challenge for us. And I think it's a sad consequence of this deluge of regulation that it acts as a barrier to entry to smaller players. But it's something we're working on, but I don't think we've got there quite yet.
Excellent, Ian. Well, we've run 5 minutes over time. We could carry on all day, but I don't think everyone's a purist like us necessarily. So we'll call it quits there. And thank you for your insights and your time. Very helpful.
Thank you.
For those of you who are still on the line, if you're an advisor, we will get you some CPD points for your attention today. So we'll look for an email from us. And if you do want to listen to a replay of this webinar, we'll provide it to you via the email, and we'll also write it up on Livewire, and it'll be on the Pinnacle YouTube channel. So thanks again for your time and attention this afternoon. And Ian, good morning to you.
Thanks very much.